All right, let's dive right in. Today, we're not just talking about investing. No, we're launching an investigation. We're going to treat stock analysis less like a roll of the dice and more like a thrilling case that's just waiting to be cracked. So grab your detective hat because the game is afoot. So this is the big question, isn't it? A lot of people look at the market's crazy ups and downs and just think, well, it's all just a big casino. But what if it's not? What if it's more like a really complex puzzle? And what if, with the right tools and the right mindset, you could be the detective who spots the clues that everyone else is missing? So here's our plan of attack. First, we'll tackle the core dilemma every investor faces. Then, we'll profile the main suspects, the different investment styles out there. After that, we're going to learn from the absolute masters, open up the analyst toolkit, and finally, learn how to spot those red flags that scream trouble ahead. Every investigation needs a motive. For us, the big dilemma is deciding what kind of investor you want to be. Are you a patient analyst or are you a frantic speculator? See, speculation is all about market timing, trying to guess short-term zigs and zags, buying and selling like crazy. It's a super high-stress game. The alternative? Thoughtful analysis. This is built on the idea that the real prize is owning a piece of a fantastic business for the long haul. And today, that's the case we're building.
Okay, let's line up our key suspects. In the world of investing, you've basically got three main profiles, and each one has a totally different way of operating. First up, you've got the growth investor. This is the futurist, always chasing the next big thing. Then there's the value investor. Think of a classic bargain hunter, digging through dusty shelves for a hidden gem. And finally, we have quality, the steady, all-weather professional who cares way more about a solid track record than flashy promises.
So let's put our first two suspects under the interrogation lamp, shall we? This is the classic rivalry. Growth investors are all about future potential. They're totally willing to pay a high price today for a company they think is going to take over the world tomorrow. They look for high price-to-earnings ratios as a sign of this excitement. Now, value investors, they're the complete opposite. They're sifting through the bargain bin, looking for low PE ratios, which might suggest the market's overlooked a solid company. The biggest risk for growth? That amazing future never actually shows up. And for value? It's the dreaded value trap, a stock that's cheap for a very, very good reason, and it just keeps getting cheaper. But hold on, this case isn't just a two-horse race. There's a third profile that often gets overlooked: quality. These are the all-weather pros. See, quality investing isn't about chasing insane growth or finding the absolute cheapest stock. It's about finding fundamentally amazing companies, the ones with consistent earnings, stable profits, and a real competitive advantage that lets them do well no matter what the market is doing. It's kind of the sweet spot right between the two extremes. To be a great detective, you gotta learn from the best. So let's turn to the absolute legends, the Sherlock Holmes and Columbo of the investing world, Warren Buffett and Peter Lynch. I mean, their methods are legendary for a reason, and lucky for us, they left a whole trail of clues for us to follow. This quote from Warren Buffett, this is the absolute heart of his philosophy. It is a total game changer. What he's saying is that the stock price you see flickering on your screen every day, that's just noise. The real detective work is figuring out the true underlying worth of the business itself, its intrinsic value. If you can buy a fantastic business for less than it's actually worth, well, you've just cracked the case. What's really fascinating is that even the master detective himself changed his methods over time. Buffett started out as a pure value guy, looking for what he called cigar butts, basically beaten down companies that had one last good puff left in them. But he evolved. He realized that paying a fair price for a wonderful company, like Coca-Cola with its incredible brand, was a much better way to go. And his massive investment in Apple, that shows he evolved again to value these powerful tech ecosystems. The lesson here? The best detectives adapt as the world changes. Now, our other master detective, Peter Lynch, he came at it from a different but just as powerful angle. His mantra was so simple but so deep. Don't just buy a stock because someone gave you a hot tip. No, do the work. Understand the company's story. What's the evidence it's going to succeed? You have to be able to explain it to someone in like 2 minutes. And this is Lynch's most brilliant idea. He argued that you, the regular person, have a secret weapon, your own experience. Maybe you notice that the lines at a new restaurant are always out the door, or that everyone in your office is suddenly obsessed with some new software. He called this the amateur's edge, and it means you can spot a booming business months, sometimes even years, before the pros on Wall Street have any idea what's happening. Lynch also knew that you can't investigate every case the same way. He created this brilliant classification system. A fast grower, which has the potential to be a 10-bagger, that's a stock that goes up 10 times its original value, well, that requires a completely different investigation than a stalwart, which is a huge, steady company. And trying to invest in a turnaround, a company that's in deep trouble, that's the most high-risk detective work you can do. Each category has its own clues to look for.
Okay, we've learned from the legends, and now it's time to open up the toolkit. Every detective needs their gear, right? Your magnifying glass, your fingerprint kit. Well, for an investor, the tools are analytical frameworks that help you slice through all the noise and get straight to the facts of the case.
In the world of stock analysis, there are really two main camps. On one side, you have technical analysis. That's all about looking at charts and price patterns, trying to guess what the crowd is going to do next. It really just asks the question when to buy. But our investigation, the kind Buffett and Lynch practiced, is all about fundamental analysis. This is about being a business analyst, not a stock market psychic. It digs deep into the health of the company itself to answer the single most important question, what to buy.
So where do you find all the evidence? Well, the single most important document you can read is the 10K report. Seriously, think of this as the official, legally required case file on a company. The business section tells you exactly how they make money. And the risk factor section, that's where the company is forced, by law, to tell you everything that could possibly go wrong. It's absolute must-read material for any serious detective. Look, I know that all this information can feel totally overwhelming at first, but having a structured process makes it so much more manageable. You can start broad, just understanding how big the company is. Then you dig into the trends. Who are their competitors? Is the stock actually priced reasonably? And, this is a big one, who is running the show, and do they have their own money on the line? Following a simple process like this turns a mountain of data into a clear story.
To really understand a company, you have to understand the neighborhood it lives in, the industry. Porter's 5 Forces is the perfect tool for, surveying the scene. It helps you figure out the competitive landscape. How brutal is the rivalry? How easy is it for new competitors to show up? Can customers or suppliers push them around? Answering these questions tells you if you're looking at a business in a profitable, quiet neighborhood or in the middle of a war zone.
Okay, this is a huge part of any investigation, knowing what to look for that signals deception or just plain danger. In investing, this means learning how to spot the red flags, those little warning signs that tell you a business might be in trouble or, even worse, might be hiding something from you. The number one reason businesses fail is, well, it's surprisingly simple. It's not usually some brilliant move by a competitor or a complex strategic mistake. As you can see right here, for almost 40% of failed startups, the cause of death is they just ran out of money. It's a pretty stark reminder that bad financial management is the most common killer out there. And so here it is, your final checklist. These are the clues that should make any investor detective just stop in their tracks. If a company's auditor suddenly quits, that is a massive red flag. If the company's doing a ton of weird business deals with the CEO's family, be very suspicious. And definitely watch out for what Peter Lynch called diversification. That's when a company starts buying up other businesses in fields it knows absolutely nothing about. These are the telltale signs that something is just not right with the case. So, after our whole investigation, what's the big takeaway? The most crucial point is this. Successful investing isn't about trying to outsmart the market's mood swings every day. It's about deep, fundamental analysis. It's about finding a wonderful business, really understanding its story, and buying it at a sensible price. It's about being a business detective, not a market psychic. So there you have it. We've walked through the methods, we've learned from the absolute masters, and we've equipped you with the analyst's toolkit. The detective's manual is officially in your hands. So the only real question left is, which case are you going to crack first?